The Intelligent Investor. Part 2. Benjamin Graham. A note about Benjamin Graham. Who was Benjamin Graham, and why should you listen to him? Graham was not only one of the best investors who ever lived, who was also the greatest practical investment thinker of all time. Before Graham, money managers behaved much like a medieval guild, guided largely by superstition, guesswork, and arcane rituals. Graham's security analysis was the textbook that transformed his musty circle into a modern profession. And The Intelligent Investor is the first book ever to describe for individual investors the emotional framework and analytical tools that are essential to financial success. It remains the single best book on investing over return for the general public. The Intelligent Investor was the first book I read when I joined Forbes Magazine as a cub reporter in 1987, and I was struck by Graham's certainty that sooner or later all bull markets must end badly. That October US stocks suffered their worst one-day crash in history, and I was hooked. Today, after the wild bull market of the late 1990s and the brutal bear market was beginning in early 2000, the intelligent investors read more profitably than ever. Graham came by his insights the hard way by feeling firsthand in anguish of financial loss and by studying for decades the history and psychology of the markets. He was born Benjamin Graham on May 9, 1894, in London. His father was a dealer in china dishes and figurines. The family moved to New York when Ben was a year old. At first, they lived the good life with a maid, a cook, and a French governess on Upper Fifth Avenue. But Ben's father died in 1903. The porcelain business faltered and his family slid hurtling into poverty. Ben's mother turned their home into a boarding house, then borrowing money to trade stocks on margin. She was wiped out in the crash of 1907. For the rest of his life, Ben could recall the humiliation of cashing a check for his mother and hearing the bank teller ask, "Is Dorothy Grossman good for $5?" Fortunately, Graham won a scholarship at Columbia where his brilliance burst into full flower. He graduated in 1914, second in his class. Before the end of Graham's final semester, three departments, English, psychology, and mathematics, asked him to join the faculty. He was all over 20 years old. Instead of academia, Graham decided to give Wall Street a shot. He started as a clerk at a bond trading firm, soon became an analyst, then a partner, and before long was running his own investment partnership. The internet boom and bust would not have been surprised Graham. In April 1919, he earned a 250% return on his first day of trading for Chevrolet Dryer, a new offering in his booming automotive business. By October, the company was exposed as a fraud and the stock was worthless. Graham became a master of researching stocks in microscopic, almost molecular detail. In 1925, plowing through the observed reports filed by oil pipelines in the U.S. Interstate Commerce Commission, he learned that Northern Pipeline Cooperative, then trading at $65 per share, held at least $80 per share in high-quality bonds. He bought the stock, pestered in managers into raising the dividend, and came with $110 per share 3 years later. Despite a harrowing loss of nearly 70% during the Great Crash of 1929 to 1932, Graham survived and thrived in its aftermath, harvesting bargains from the wreckage of the bull market. There is no exact record of Graham's earliest returns, but from 1936 until he retired in 1956, his Graham Newman crop gained at least 14.7% annually versus 12.2% for the stock market as a whole, one of the best long-term track records on Wall Street history. How did Graham do it? Combining his extraordinary intellectual powers with profound common sense and vast experience, Graham developed his core principles, which are at least as valid today as they were during his lifetime. A stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business with the underlying value that does not depend on its shares price. The market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. The intelligent investor is a realist who sells the optimistic and buys from pessimistic. The future value of every investment is a function of its present price. The higher the price you pay, the lower your return will be. No matter how careful you are, the one risk no investor can ever eliminate is the risk of being wrong. Only by insisting on what Graham called the margin of safety, never overpaying, no matter how exciting an investment seems to be, can you minimize your odds of error. The secret to your financial success is inside yourself. If you become a critical thinker who takes no Wall Street fact on faith, and you invest with passion and confidence, you can take steady advantage of even the worst bear markets. By developing your discipline and courage, you can refuse to let other people's mood swings govern your financial density. In the end, how your investments behave is much less important than how you behave. The goal of this revised edition of The Intelligent Investors is to apply Graham's ideas to today's financial markets while leaving his text entirely intact with the exception of footnotes for clarification. After each of Graham's chapters, you will find a new commentary. In this reader's guides, I have added recent examples that should show you just how relevant and how liberating Graham's principles remain today. I envy you the excitement and enlightenment of reading Graham's masterpiece for the first time, or even the third or fourth time. Like all classics, it alters how we view the world and renew itself by educating us. And the more you read it, the better it gets. With Graham as your guide, you are guaranteed to become a vastly more intelligent investor.